Hello traders, welcome back to Hope Pips, your go-to channel for mastering forex trading strategies. I'm thrilled to have you here for another episode where we unlock the secrets to trading success. Today we're diving into one of the most powerful concepts in trading, institutional supply and demand zones. These zones are the foundation of aligning with big players, the institutions, and avoiding the traps that catch most retail traders. We're going beyond the basics, breaking down step by step how to identify these zones, why they work, and how to trade them like a pro. Whether you're a beginner or a seasoned trader, this video will level up your game. If you're new to Hope Pips, hit that subscribe button and give us a thumbs up to join our growing community of profitable traders. Let's get ready to transform your trading. See you after the intro. Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, without wasting our time, let's get into the topic. Here is the topic. Welcome back, traders. Let's kick things off with the core of today's topic, supply and demand in forex trading. At its heart, supply is the amount of a currency available to trade, like the US dollar or euro floating in the market. When there's a ton of a currency ready to be exchanged, supply is high. Demand, on the other hand, is how much traders and investors want to buy that currency. High demand means lots of buyers are eager to get in. Here's the key. Price moves based on the balance or imbalance between supply and demand. If demand spikes but supply stays steady, the price of a currency climbs. If supply floods the market while demand holds steady, prices drop. Picture this. If buyers overwhelm sellers, prices surge and they hit a supply zone, where enough sellers step in to balance things out. Every trade needs a buyer and a seller. Someone's always on the other side. These dynamics create the price action we see on our charts, driven by millions of orders from retail traders to massive institutions. Why studying these key zones, we can spot where institutions are active. Their trades leave footprints in the market, and those clues help us predict price movements with high accuracy. At Hope Pips, we're all about trading smarter, so let's explore how these institutional moves shape the market and how we can follow them. Section 2, how supply and demand zones. So how do supply and demand zones actually form? It all starts with a phase called the base, where the price moves sideways in a tight range. Think of it as the market taking a breather, gathering momentum, and pulling in players, both retail traders and institutions. This consolidation sets the stage for a big move. Let's break it down with a bullish example. Imagine the price is consolidating in a base. Suddenly, buying pressure surges, creating a massive imbalance where demand outstrips supply. The price rockets upward, breaking out of the base to find enough sellers to balance the demand. This breakout creates a demand zone, a price level where institutions placed heavy buy orders. Why does the price return to this zone later? Simple. There's not enough demand to keep pushing higher, so the price pulls back to find new supply, filling the imbalance. Plus, institutions defend their buy positions in these zones to protect their profits, often adding more orders if the price revisits. The same logic applies to a supply zone in a bearish scenario. The price consolidates, then selling pressure spikes, breaking the base downward. This forms a supply zone where institutions sell heavily. When the price returns to this zone, it's because institutions are re-entering with more sell orders to maintain their bearish control. At Hope Pips, we teach you to wait for the price to revisit these zones before trading. Why? Because that's where institutional money flows back in, giving you a high probability setup. The process follows 4 steps: base expansion, retracement, and continuation. We focus on entering during the continuation phase to ride the institutional wave safely. Let's keep going and see how to spot these zones on your charts. Section 3, identifying supply and demand zones. Now let's get practical. How do you spot supply and demand zones on a chart? The market is fractal, meaning patterns repeat across all time frames, whether you're on a 5-minute or a daily chart. Let's say you spot a demand zone on a 15-minute chart where the price consolidates, then surges upward. Zoom out to a 30-minute chart and that same zone might appear as a single bullish candle just before a rally. This is called a bullish order block, the last selling candle before a big upward move. For a supply zone, it's the opposite, a bearish order block, the last selling candle before a sharp drop. To identify these zones, focus on the base area before a breakout. Here's how it works. Range zones. Highlight the candles in the consolidation range just before a strong breakout. This gives you a wider zone but a larger stop loss. For a demand zone, it's the last bearish candle where the next candle closes above its high. For a supply zone, it's the last bullish candle where the next candle closes below its low. This method tightens your stop loss for better risk reward, but may miss some trades. Fractal zones. Look for patterns like inside bars or large candle wicks. Wicks often hide lower time frame ranges, acting as demand or supply zones. Each method has trade-offs. Range zones reduce missed trades but increase stop loss size. Pivot zones are precise but risk missing setups. At Hope Pips, we recommend testing both to find what suits your trading style. Consistency is key, stick to your rules. Let's explore the main types of supply and demand patterns to supercharge your trading. These fall into three categories: reversal, continuation, and flip patterns. Reversal patterns. The price drops, consolidates in a base, then surges upward, signaling a shift from bearish to bullish. Enter long when the price revisits the demand zone. Rally base drop. The price rallies, forms a base, then crashes downward, indicating a bullish to bearish shift. Short the supply zone on the retracement. Continuation patterns. Rally base rally. The price rallies, pauses in a base, then continues upward. This shows strong bullish momentum. Buy when the price revisits the demand zone. Drop base drop. The price drops, consolidates, then continues downward. Short the supply zone when the price returns. Flip patterns, my personal favorite. Demand to supply flip. In an uptrend, the price fails to make higher highs, taps a demand zone, and breaks below it with selling pressure. The broken demand zone becomes a supply zone, short when the price revisits. Supply to demand flip. In a downtrend, the price breaks a supply zone upward, turning it into a demand zone. Buy when the price returns to test it. These patterns help you align with institutional moves. At Hope Pips, we'll dive deeper into flip patterns in future videos, but for now, practice spotting these on your charts to build confidence. Section 5. Tips for strong supply and demand zones. To trade like the pros, you need to identify strong supply and demand zones. Here are 3 key tips from Hope Pips. First one is strength of the breakout. The stronger the breakout from a base, the more significant the zone. A powerful rally or drop signals heavy institutional orders, making the zone more likely to hold when retested. Simply the clean. Note that clean range is must and should. It should be minimum 25 pips. The second one is time in the zone. Zones formed with minimal consolidation time are stronger. Less time spent in a base means a bigger supply-demand imbalance, showing aggressive institutional entries. The third one is freshness of the zone. A zone loses strength each time it's retested. Fresh, untested zones have more unfilled orders, making them more reliable for reversals. Combine these factors with your chosen method, you'll spot high probability setups. For example, a demand zone with a sharp breakout, short consolidation, and no prior retests is a goldmine for long trades. That's a wrap, traders. We've covered the essentials of institutional supply and demand zones, from how they form to spotting them like a pro. By aligning with institutional key zones, trade smart, not harder. At Hope Pips, we're committed to helping you become a consistently profitable trader, so practice these concepts on your demo account first. In our next video, we'll show you how to refine these zones into a winning trading strategy with real chart examples. Don't miss it. Subscribe now and hit the bell icon so you never miss an update. If you found this video helpful, give it a thumbs up and share it with your trading buddies. Want to stay ahead with market news? Check out platforms like FOREX Factory for real-time economic calendars and trading tools. Drop your questions or favorite supply and demand tips in the comments below. I love hearing from you. Until next time, trade smart, stay disciplined, and keep chasing those pips with Hope Pips. See you soon.